Hey everyone, and welcome to today's show on Wealth Strategy Secrets. Today we're joined by Alix Kogan. Alix has been involved in real estate, construction, and development for the last 20 years. Alix started his career in Colorado, founding his own high-end construction company and grew it to be the largest and most successful firm in Southwest Colorado. After 20 years there, Alix had a successful sale and liquidity event in late 2019. Shortly after starting his own building company in '99, Alix started investing in real estate with single-family spec homes, single-family rentals, commercial and multifamily rentals. Over the past 15 years, Alix has successfully completed several townhome, mixed-use, and single-family developments. He currently has over 1,700 apartment units as an LP, co-GP, and KP, and also self-manages his portfolio of single-family rentals as well as a small portfolio of commercial properties. And in addition, Alix invests and owns a substantial portfolio of mortgage notes. He's had various multifamily experiences with building, owning, and managing assets, and Alix has a broad-based experience and knowledge of multiple real estate asset classes and is focused full-time on growing his private equity real estate firm, Ashland Capital. Alix, my friend, welcome to the show.
Thank you. Good to be here, Dave. Hearing you read that reminds me I need to update that. It's grown substantially, but anyway, I'm glad to be here, Dave.
Yeah, it's funny with a lot of, high-flying entrepreneurs that, we're always working with and in circles, the resume changes infinitely every 90 days. A lot of people in this space, big aspirations, making big things happen like yourself. But, really excited to have you on the show. I think investors are really going to enjoy this perspective, and it's just been a pleasure getting to know you over the past few years. And some of our investors have had the opportunity to invest with Ashland Capital as well on one of the projects. So can you tell us a little bit more about your background and how it all started? How did you get into construction and real estate really from the beginning?
Sure. Well, I grew up in a very entrepreneurial family. My dad was a builder developer. My brother is a builder developer investor. So, I just grew up around it. I actually thought that I was not going to follow in the family footsteps and I was going to save the world. So I had this, in my early 20s, a stint of traveling the world as well as teaching high school. And that was going to be my path. I wanted to coach soccer, teach high school, have my summers off, and I thought that was going to be, this perfect life. So I was a little naive, a little young and dumb, and not that that wasn't, an admirable sort of goal, but the reality set in, and there I was teaching, making I think $26,000 a year, but I had my summers off and no money to live on in the summer. So the light bulb kept on going off. Is this really right for me? And I think the biggest decision point for me was that I actually did not enjoy teaching. I enjoyed the interaction with kids, coaching, but I didn't really enjoy just cramming information down their throats and et cetera. So I, in late 98, I decided to quit teaching, move to Colorado, move to a little town called Durango, Colorado, where my ex-wife and I vacationed, and thought this was a great place, looked around and thought this would be a good place to go back to my roots, which is construction, development, real estate, and that's where it started. So went to work for a builder for about a year and then started my company, and it just took off and always lived under my means, and was really successful. I think we doubled in size every single year for many years, and all that capital, all that profit, I put right back into real estate. So that's how the journey started.
Great. And what were you actually doing when you started with that construction company? What was your role? What were we doing?
So the company was design build. I always had a strong affinity for design and construction, obviously with my background. So we designed and built high-end custom homes, and Durango primarily was second homes, so vacation homes, your typical mountain resort style vacation homes, and that's what we did. Started small. It was myself and an employee and a half, and fast forward to when I sold in 2019, it was, probably about 60 employees. And, it was vertically integrated. We had architects, designers, of course, all the carpenters, construction crew, superintendents, admin, etc. And then we had a development arm of the business where we would develop small multifamily, mixed use, land development, single family, of course. So it was both the custom business as well as the development speculative business. And then sort of the third leg of that whole stool was my own personal wealth that I plowed back into acquisitions. So, buying rentals of all sorts and sizes, so to speak. So, and then, about 2017 was really the shift in the pivot to what Ashland Capital is today.
Right. Which is, maybe, you could share a little bit in terms of Ashland, what your focus on, your markets, your niche,
Sure. So 2017, I realized that I did not have to own real estate in my backyard, that I could buy larger assets. I could buy them around the country, hire third-party property managers. Prior to that, we self-managed everything that I owned in my portfolio. It was not syndicated, it was all my own capital. So the whole, syndication of structuring it where you can partner with limited investors, buy larger assets, buy them around the country, hire best-in-class property managers and then manage those property managers was a new concept in 2017 to me. But that's where it started. And so I started investing as an LP. I started helping guys that didn't have the net worth and liquidity as a KP. I started partnering with guys as a GP, where I would help them with a number of different things. So that's really kind of the early stage. And then quickly thereafter, I just said, this is something I understand, I can get my arms around. And I started, being a lead sponsor and buying two verticals, 100+ unit multifamily around the country, and then as well as student housing, which is we buy a minimum of 100 beds. Student housing, of course, is sold and run by the bed rather than unit
or door. Yeah. Interesting. So we'll jump into a little bit more about what you're doing in the future, but just want to also ask you, what is your personal wealth strategy, right? In this show and a lot of things that we talk about, right? It's really all about the process of building wealth, right? And not particular one asset or one ROI, but, a process around doing that, a strategy, right? And I know you're a member of Tiger 21 and you've had some great success. So, help us share with the audience a little bit about your strategy.
So, strategy changes as you get older. My strategy now is different than it was 10 years ago. 10 years ago, I was taking a little bit more risk than I take today. But that's sort of what I call the building, building your net worth in the building years. I'm certainly building, but I would say I'm sort of in the second phase of my career where I'm taking less risk. And for me, it's right now, the eye is on risk-adjusted returns. So everything I do today is with the eye of what's the worst case scenario, what's the best case scenario, what's the base case scenario, and really measuring that. So I only have a certain amount of hours in the day. I only have, a certain amount of capital to deploy. And I only have a certain amount of, investors and their capital that's the most important for me to protect. So everything I do is a very measured analysis of those things. So simply put, I'm not shooting for home runs with real estate in most investments. On occasion, I'll do something with a very small allocation of my net worth that's, maybe in the home run category, and that's typically with blockchain, crypto, etc. And we all know how volatile that has been lately, and that's why. So that's a very small allocation. If I lost all those dollars, it wouldn't change my life. So it's fun, it's interesting, and I'll play around with that space. And Even though that allocation of my portfolio is down right now, I'm not going to sell. I believe in the space, and it's just a long-term play. So, so that is really how I kind of look at generically. And then when you get into more of the nuances and the granular aspects of evaluating opportunities, I'm very focused on after-tax returns rather than pre-tax. So I want to make sure that that what I'm doing is smart, that it's at least long-term capital gains. It has opportunities like real estate with depreciation to defer gains, etc. So that is definitely a large focus of how I allocate my investments.
Yeah, absolutely. And so what do you like about the student housing asset class? Talk about some of the attributes of why you gravitated to that.
Sure. So I got my start in student housing in Colorado, and I realized that I like the student housing population, other than the fact that it could be a little rough on the asset, as you can imagine, as I was when I was in school. But I always had success. I owned college. It wasn't even called student housing. The institutional, professional sort of asset class of student housing has only been around for 20 years or so. Prior to that, it was just mom and pops, owned single families, duplexes, small apartment buildings. There just wasn't a lot of institutionalized student housing. So I had rentals. I had really good success with rentals. I thought it was, pretty easy to deal with college students, believe it or not. So that's how I got my start. In the last 4 or 5 years, I've obviously graduated to institutional level assets. And I like them for multiple reasons. Number one, it's a higher barrier to entry. Not every investor, not every multifamily guy is going to invest in student housing. It's more of an operational play. You have to have that expertise. So there's less players, which is less competition, which we like. Number two, I like the fact that it is a counter-cyclical asset class. When you have softer economic times, college students actually go back to school or stay in school longer. So where we are today, we're seeing record enrollment, record rent growth, not across the board, not at every campus, of course, but the type of campuses that we focus on, yes, we're seeing really good performance. 2008, 2009 were some of the best years for student housing. So, certainly like that. Like the fact that there's parental guarantees. So your vacancy or your delinquency rate is typically very, very low in student housing as compared to conventional multifamily. And I like the diversification. I don't want to have all my eggs in one basket and just invest in apartments. I want to have an allocation to student housing. So it continues to be a great asset class to invest in. We do have the expertise. A good friend of mine and partner of mine here in Chicago is one of the absolute best student housing property managers in the country. Small boutique, has been in it for 25 years. Every one of our assets that we own is exceeding pro forma by a large amount. So it's a place we're comfortable, and it's a place that we've done very well.
So how about in terms of the pandemic, right? Weren't there a lot of students who dropped out, right? And you had some vacancy there?
Great question. There is just a generic view of exactly that's what happened. It sort of happened, but not really. So what happened is when the pandemic hit, kids actually, some kids did not want to go home. In fact, many kids did not want to go home because they didn't want to sit in their parents' house or basement. They want to be around other kids and stay on campus. So a lot of kids stayed on campus. Some of the ones that went home and actually did distance learning, whether on campus or back home with mom and dad, they continued to pay rent because of what I just mentioned, parental guarantees. So if your parents are guaranteeing your rent, your parents are likely middle to upper class. They're going to make sure they keep paying rent. I mean, you're obligated, obviously. So while vacancy was higher, no question, delinquency was not that much higher than typical because kids continued to pay. So that was the initial reaction to the pandemic. Fast forward to us coming out of the pandemic, more or less, what we've seen is a huge spike and increase in demand in off-campus housing. So parents realized, you know, do I want my kid sharing a small dorm room and then sharing a bathroom with 10 other kids or 20 kids? No, I want my kid to have their own bedroom, their own bathroom, more space, outdoor space, potentially even a balcony. So coming out of it, we've seen incredible demand for what we do, which is off-campus private housing with equal bed bath parity. So every student has their own bedroom and they have their own bathroom. And that's been in huge demand.
Wow, that's interesting. I wouldn't have thought about it that way. And then what would you say in terms of, again, people are kind of new to the asset class and everything, probably the biggest knock or something that you could think of is college students, right? So are they, destroying your places, right? I mean, how does property management really go with that?
Sure. So it goes back to operations. So there's some property managers that come July, August, as students are vacating units and either moving out or going home or graduating, whatever they're doing. That's when they inspect units and they say, oh, gee, well, somebody did X, Y, Z. They owe me, $1,000, $2,000, or it's fine. We don't wait. We actually inspect them on a quarterly basis. So as damage is occurring, we're fixing it and we're charging the students. So it's not a big problem at all. In fact, oftentimes, we're getting 60-70% of our what we call turn cost. That means going in, getting the units ready, touch up paint, clean, etc. We're getting a significant amount of our internal cost paid for by chargebacks. So we're charging back, of course, the students, their parents, for any kind of, a ding in the drywall. I mean, anything that's, above and beyond normal wear and tear. So
right.
Long way of saying, Dave, it's not an issue. It's all built into the business model, not a problem.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Good. And then how do you have really a gap in that vacancy during the summer months? Or is that filled through summer school and things? How does that work?
12-month leases. So we only do 12-month leases with the exception, let's just say we got to 97% occupancy by July, August, something like that. And we have, a handful of vacant units. We will backfill them if there's a need for a short-term lease, where it might be a 6-month lease, maybe first semester, second semester, what have. But we're going to drive to at least 95% occupancy with 12-month leases, and that's the norm in any kind of institutional grade student housing.
Nice. I remember being on the other end of that, writing the check and signing over the lease for my daughter on one. So yeah, I mean, it does seem like your bases are really covered, right? Because, you can charge the students, you have your parents, backing, right, their lease agreement, and they seem to be quite, aggressive in terms of, managing any delinquencies, things like that. So
yeah, the other nice thing about student housing, it's a lot more turnover, which somebody might think about as a negative. Mm-hmm. But the positive of that is every year you have an opportunity to raise your rents. It's harder to raise rents for people that are renewing, but for new leases, of course, it's much easier.
Yeah,
because you're just reacting to the demand in the market.
Right. And are there any particular markets that you're focused on? Does some of that vacancy really, is it dictated upon, the market or the university that you're actually in?
Yeah, that's the key to every investment, whether it's multifamily or student, but especially in student, it's very important to know, is enrollment growing? So what is the health of the school? What's going on at the school? And then the supply and the demand. And where are you within sort of all the different asset classes? I mean, you have C, B, and A type of student housing. You could be, core asset, Main on Main, pedestrian to campus. So you have to understand where you are, but all of that is based on supply and demand. So for example, you can have a school like Texas A&M, College Station, where, you know, it's a great school, enrollment is growing, but all of a sudden the supply just floods the market, and then everybody's lowering their rents so they can compete. So schools do go through a cycle of that. You just have to be very careful that you know where in the cycle, you know, they are, and where you are within all the different asset classes. So it's like anything, you know, data, you have to understand it and have to make a good decision.
Yeah, absolutely. And that brings up a good point. You and I have had several conversations this year, interest rates, cap rates, inflation, and everything. And I know you were on a panel speaking at the recent conference. So can you share your current, you know, perspective on the market climate and, you know, what you're seeing?
Yeah, I think it's an interesting market. I think it's a market that's trying to sort of find its legs and figure out where we're going. So it's definitely kind of in transition. The biggest issue, of course, is the debt market. We've got, you know, a much higher cost of capital, and sellers are just haven't reacted to that. So either they still think they're sellers, but they're wanting, you know, 6 months ago's pricing, and obviously we're not going to pay that. So that's where we're trying to find this equilibrium, where pricing is today, and getting sellers to just understand that now this is the reality, and selling for today's prices. So some sellers are just going on the sidelines. And that's a smart thing to do. We're selling an asset in 2 weeks, believe it or not, for an insane price. We found somebody that is just extremely aggressive, extremely bullish on the market. We don't think that if we held it, we could ever get to the rents that they predict that they can get to. We're going to sell, but if you don't have to sell, which, you know, let's hope you don't have to sell, you shouldn't sell in today's market. But we see it as an opportunity. There's plenty of people that have to sell. They may have their loan expiring, they may have floating rate debt, they may be in a negative cash flow situation where they want to get out, and we think that's the opportunity. And some buyers are also on the sidelines. They're just, you know, kind of a deer in headlights, wanting to see what's going to happen with the recession. We're confident in the asset class. You just have to buy right, buy in the right MSA, and it has to be the right opportunity. So we're looking and making offers every day.
First law of real estate, right? Buying right from the start.
Absolutely.
Yeah. So do you think maybe, you know, maybe next year the buying opportunities could be a little bit better, and maybe in the next 12 months or so? You
know, I tend to think that the buying opportunities are best when there's most uncertainty and most distress. So I don't know how long that sentiment will last. I think as we have more clarity on the economic cycle and the recession, I think people will actually have more confidence. And I think pricing, I think we'll have more volume as that happens, because people have more confidence. Sellers are going to, you know, come off the sidelines and want to sell. If we have the debt markets level out a little bit, people kind of understand where they are. I don't think that's going to come back down to, you know, 2.5–3%. But if it comes down to 4–4.5%, we kind of know that it's stabilized, then I think you're going to see more transaction volume. But I think to find the deals, you have to find them in a distressed situation. I think that's right now. So yeah. I think the next few months, 3 to 6 months, is a great buying opportunity.
Nice. Very, very well said. So shifting gears a sec, Alix, you know, you've obviously achieved a great deal as an entrepreneur. What is the one biggest thing from a personal development perspective, you know, that you could share? We have a lot of entrepreneurs on the show that, you know, has helped you yield success.
On the personal development, I would say I've had really good success with either a great team, so employees of mine that have been, you know, invaluable, that have always been a great sounding board, that have offered me a great perspective that I may have not thought of. So I've been very fortunate to have a great team. My CFO of about 18 years now is still with me with Ashland Capital. Started with me in Colorado. He still lives in Colorado. He's remote. He's been outstanding. I'd say in addition to that has been Tiger 21, Strategic Coach. Those are a couple of the groups that I've been a part of. Those have been very good. I think you only know what you know. You to be able to triangulate, to be able to learn from and have mentors, friends, and just opportunities, and be surrounded by really successful entrepreneurs is an incredible thing to do. And even when I had my construction development company, I was part of a group called Builder 20, top 20 builders around the country. It was like having a board of directors of 20 of the best entrepreneurs around the country.
Yeah.
It was full disclosure. They knew everything about my financials, my personal life, my professional life, and I could pick up the phone anytime. We'd meet twice a year. I could pick up the phone anytime, any day, and call any one of them and say, "Hey, I ran into this issue. What do you think?" So if you can surround yourself with those kind of people, I think that's the best personal development that you can make. And that's more business focused. I mean, there's other things obviously that I focused on that I've been good and I've been bad with, such as just state of mind. I've gone in and out of trying to meditate. I've been really good on fitness and nutrition. I've also been bad. I will say that I'm in my bad phase right now, and COVID certainly set me back. But those things are key for me as well, just to have good clarity, good state of mind, the typical cliches of just health and wellness.
Yeah. It's really the foundation to whatever it is you're doing, right? If you don't have that as the basic building block, it's hard to achieve a lot. And I totally agree in terms of the people. I mean, you're really a product of the 5 people you spend the most time with. So being involved in some of those mastermind groups, and I didn't realize you were in Strategic Coach. I'm in going on 5 years now myself,
Nice.
and it's been it's just been such a phenomenal program, completely structured for entrepreneurs trying to scale businesses, and just getting that feedback, sharing ideas, because most of the time people tell us we're crazy with the things we want to accomplish as entrepreneurs, but that's a group that really encourages you and asks the right questions. It's all about asking the right questions, really. So that's great.
Yeah.
If you could give us just one piece of advice in terms of investors trying to accelerate their wealth journey, what would it be?
I guess I would say really figure out, are you a limited sort of passive investor or are you an active investor? I think people that try to do a little too much of one or the other relative to where they are in their lives and their businesses, I think can really affect that. So, I see a lot of people that have a day job and then they're trying to have a lot of side hustle and businesses. And I think that could be a little dangerous because you're not focused. I mean, I think you and I have talked about that. There's a number of real estate syndicators where it is a side hustle. They have a day job and they're syndicating deals. I personally would never invest in someone that is a side hustle and they're not full-time. So from an investment standpoint, I think you got to look at things in the same lens. If you have a day job, if you're busy, find the right sponsors. I always bet on the jockey. That's number one. So it's the sponsor, and then I look at the asset or the business plan second. But it's the people. You can have a great investment, but a horrible operator, and you're going to get in trouble. But if you have a great operator and an okay investment, generally that'll work out better for you.
Right. Yeah, no, completely with that. I mean, this is a people business. It's all about the people, and the numbers can present one thing. And I tell investors that as well, is it's kind of counterintuitive, right? Because if you find one deal, let's say one deal is an 18 IRR, is it better than the deal that's a 15 or 16, right? And on the
Absolutely.
surface, people might say yes, but it is all about that team, because they could actually double it or triple it. You never know. It's all about actually executing to the business plan and exceeding that.
100%. I can't tell how many times we've had investors that say, oh, I like your deal, it's the 16 IRR, but I'm looking at another deal that's an 18 IRR. I said, you're looking at the wrong thing. Look at the underwrite, look at the sponsor. And that deal is the one that I just mentioned that's going full cycle in 2 weeks. We're going to return a 33 to 35 IRR. And if I wanted to be a little brat, I would call that guy and say,
right,
that you passed on. You thought 16 was low. Well,
yeah.
Anyway, you get my point.
Yeah, absolutely. So speaking of people again, I think this is really cool, Alix, that you've done. And you actually, you started your career, like you said, you had the family business that was entrepreneurial and in the construction industry. And you've brought your son into the business as well, who's an awesome guy.
Son. He's actually not my son. So
He's
Eric is my nephew. But
he's your nephew.
You're not the first one to assume that he's my son, because he's 25, 6 years younger than I am, so he could be my son. But Eric is my nephew. So he is my oldest brother, my only brother.
Okay.
There's kid.
Okay. Well, he's done a phenomenal job, and it's great to, bring family into the business, and I think, a lot of these things that took us, so many years to learn, and these lessons and these pitfalls, obviously we're trying to bring these to our kids as well. So, trying to groom my daughter and my kids into potential roles. So I think it's great that you've been able to do that, though.
Yeah, it's been great. It's tricky sometimes, the family, but at the end of the day, I think I'd rather have that dynamic than not. So Eric has been unbelievable. He's a great asset to the team.
Yeah, great. Well, Alix, really appreciate your time today. If people would like to get in touch with you, learn more about Ashland, what you guys are doing, what's the best place for them to reach out?
Easy, just go to our website, ashlandcapitalfund.com, ashlandcapitalfund.com for the website. You can obviously reach me through that, or if you want to email me directly, it's Alix with an I. I can't spell my name, so ALIX at ashlandcapitalfund.com.
Awesome. Thanks again for coming on the show today. We'll put all the link for that in the show notes for everyone, and really appreciate your time, Alix.
Thanks, Dave. Great to see you.